Hello, this video is a little long, but I really think it's worth it, and I'm going to try to talk a little slower. So I hope everybody is doing well. And I want to talk to you about something that I genuinely believe is one of the most important economic stories happening in a long time. And the thing that concerns me most is that almost nobody in the media, nobody in politics, and very few people on Wall Street are addressing the actual depth of this. I'm talking about oil, but it's actually bigger than oil. Aramco, the largest oil producer in the world, has said publicly that we are in the biggest oil crisis in history. And that even if the war stopped today, it would take 20 months to get the supply back online. Although we've been told the war is over and Iran has been disseminated, the words in reality don't seem to connect. Here's why this matters beyond what you pay at the pump. A sustained oil shock doesn't just raise gas prices, it moves through the entire economy like a slow wave. Diesel goes up, diesel's trucks run on that. Construction equipment, agriculture, mining, and shipping. When diesel goes up, food prices go up. But not just because tractors run on it, but because fertilizer, refrigeration, packaging, processing, and every truck that moves the food to your grocery store runs on it too. Freight costs explode. Manufacturing margins get squeezed. Companies either absorb the cost and earn less, or they pass it through and create more inflation. But here's the part that almost nobody is talking about, and this is the one that genuinely concerns me. One third of all globally traded fertilizer passes through the Strait of Hormuz. The conflict has damaged or shut down major fertilizer production facilities across Iran, Qatar, Saudi Arabia, and the UAE. There are no strategic fertilizer stockpiles internationally, and alternative production elsewhere is already limited. And here's where it gets really dangerous. Fertilizer producers in India, Bangladesh, and Pakistan had to shut down their own production because they've been cut off from the natural gas they need to make it. So it's not just that Gulf fertilizer can't get out, it's that countries who normally make their own fertilizer can't make it either because their supply is gone too. Global fertilizer prices are projected to be 15 to 20% higher in the first half of next year than a year ago. And that's before the planting season fully plays out. Less fertilizer means less crop yields. Lower crop yields means less food. Less food means higher prices in some parts of the world, real hunger. This is a slow-moving crisis that is going to show up on your grocery bill and an emerging market instability before most people even understand what happened. And here's where it really gets complicated for central banks and for the markets. Normally, when the economy slows, the Fed cuts rates. But if oil and food are driving inflation back up at the same time the economy is weakening, it's hard for them to cut. They're trapped. They can't raise. That combination, raising inflation plus slowing growth, is called stagflation. And it's historically one of the most difficult environments for both stocks and bonds. There's also a second problem that's easy to underestimate right now. Countries and companies can mask a physical supply shortage by drawing down their inventories. Everything looks manageable on the surface until inventories get low. Then buyers start competing aggressively for whatever barrels are available, and price movements can become non-linear, fast. That's the moment things can stop looking orderly. The two numbers I'm watching more closely are physical crude exports through the Strait of Hormuz and diesel availability and prices. Crude tells you that the scale of the supply. Tells you the supply problem. Diesel tells you whether it's starting to affect the real economy. Now, what are we doing about it? We are positioned in energy and commodities, which is exactly what we want to be in if this plays out the way I think it could. I strongly believe it will. We still have some technology exposure because the AI build-out is real. It's explosive and has been one of the strongest economic forces of the last 2 years. But I want to be honest. It's harder to say with confidence that the AI trade holds at these levels if the broader economic picture continues to deteriorate and oil stays this high. That's the conundrum we're navigating right now. We're not abandoning it, but we're watching it very closely. We're also positioned in defense. If you've been listening to what I just said about escalation and the war not being as resolved as we've been told, then you understand why we're in defense. Defense spending doesn't go down in environments like this. It goes up. Governments around the world are rearming, contracts are expanding, and companies we own in this space are direct beneficiaries of exactly the environment I just described. It's one of the few sectors where geopolitical chaos actually works in our favor. We are also positioned in gold and silver, and I want to take a moment to explain why, because history here is important. Since 1913, when the Federal Reserve was established, the dollar has lost over 97% of its purchasing power. But that decline hasn't been smooth or steady. There has been periods when the dollar was strong and sideways, and during those periods, gold and silver did very little. But every single time the dollar took a meaningful step downward, every time the currency lost real value, gold and silver didn't just go up, they went up dramatically. That pattern has repeated itself without exception for over 100 years. Right now, the dollar is under pressure from every direction. Oil, debt, the Fed being trapped, geopolitical instability. If that pattern holds, and I believe it will, gold and silver are not just a hedge, they are the trade. What I don't want you to do is get caught off guard by this if it accelerates. Most people won't see it coming because most of the people who are supposed to be telling them about it are not. That's exactly why I'm telling you now. I've never been someone who follows the consensus just because it's comfortable. That independence doesn't always make the easiest person to listen to, me. It doesn't always feel good in the moment. But there's an old saying I keep coming back to right now. The truth will set you free, but first it will make you uncomfortable. What I'm telling you today is not comfortable. You're going to hear most of it. You're not going to hear most of it on CNBC or from an average advisor who's worried about saying the wrong thing. But I'd rather tell you something that's true, that's hard to hear, than something soothing that leaves you unprepared. And I want to add something that I don't say lightly. I've been telling you for months that rates were not going to go up, that the war wasn't going away, that metals and energy were where you wanted to be. All of that is playing out. And now I want to tell you what I think comes next. Not to alarm you, because you deserve to hear it from me before it's on the front page of every newspaper. I'm really putting myself on a limb here, but I believe this gets much worse before it gets better. Significantly worse. The oil situation is not resolving. If anything, the conditions are building toward a major escalation. And if that happens, oil just doesn't say hi. It goes to levels most people alive today have never seen. And when that happens, everything I just walked through, the inflation, the stagflation trap, the pressure on the Fed, the fertilizer crisis, the cost of everything accelerates at a pace that will catch most investors completely off guard. I don't know exactly when, nobody does, but I know what the setup looks like and I know how to position for it, and that's exactly what we've been doing. October, I think, is the month that we're going to see something, if not before. Then the goal isn't to predict doom. The goal is to make sure that when this plays out, and I believe it will, your portfolio is on the right side of it. Energy, commodities, defense, metals, hard assets. Things that go up when the dollar is under pressure and the world is paying a premium for real things. I'll keep you updated as this develops, and as always, reach out to me anytime if you'd like to walk through your specific situation. And please forward this video to anyone who you think needs to hear this. Thank you for listening.